to Northwest Capital Management's market summary for the second quarter of 2023. I'm Brent Petty, and I will be your host for this video. Now let's begin. As you can see in the chart, the equity markets continued the surge through the second quarter of this year. U.S. equities, moderate growth continued while both international developed and emerging market equities remained positive, but at a slower rate, while fixed income and bond markets produced slightly negative returns. In this video, we'll discuss the following key themes and how they affected the markets. First, we'll start with the Fed's recent decision to pause rates and the uncertainty surrounding future rate hikes. Second, we'll take a closer look at the latest inflation trends and the economic indicators influencing the market. Third, we'll update you on the likelihood of a recession, which seems to be decreasing, and the factors contributing to this assessment. And finally, we'll conclude with our review by providing updates on the labor market and addressing concerns about rising credit card debt and shifts in consumer sentiment. And as always, we'll recap the market returns for this latest quarter. As you can see from this chart, the Fed has been very aggressive in its approach over the past year as it relates to rate hikes. However, in June, the Fed opted not to raise rates, keeping the federal funds rate within the 5 to 5.25% range. This marks the first meeting since March 2022 where the Fed chose to not raise interest rates. With the Fed funds rate now surpassing CPI inflation, we may be nearing the end of the rate hike cycle. However, mixed signals from the Fed have created uncertainty. Following the June pause, 12 out of the 18 Fed officials projected a possible increase of at least another half point by the end of the year. In July, the Fed raised rates another quarter point to the range of 5.25 to 5.5%. So while the Fed paused its rate hikes in June, it raised rates in July and continues to send hawkish signals with its messaging. Now let's take a look at some of the inflation data. The good news is that while inflation remains high, it is no longer accelerating, and there are signs that it will be headed lower in the second half of 2023. As the chart here shows, lower energy prices have played a crucial role in driving down inflation. Recent data indicates a deceleration in food prices. Both used and new car prices have declined for several months due to improvements in the supply chain. Shelter, which is a lagging indicator, remains the main driver of inflation, but it also is expected to begin to fall. These changes in inflation signal that it may be possible to curb inflation without requiring a recession, which would be welcome news. Now let's take a look at the diminishing risk of a recession. As this chart shows, historical data indicates that stocks tend to do well when inflation rates are lower than the previous year. The outlook for lower inflation in 2023 has created optimism among investors. As the economy continues to normalize, the looming threat of a recession has started to fade. The adverse effect of the rate hikes have begun to subside, leading to growing stability in housing, business, and the overall market. One of the strongest indicators of a resilient economy right now is the labor market, which we'll discuss next. The strong labor market is one of the reasons why the likelihood of a recession has decreased. Job creation has remained impressive, with 1.7 million jobs added in the first half of this year. As you can see in the first chart, hiring remains very strong. May payrolls, which measure the number of private sector and government jobs created, came in at 339,000. Non-farm payrolls increased 209,000, which is not reflected in this chart. This was a decline from May, but still far above the pre-pandemic average. And as the second chart indicates, the current labor market is probably the strongest we've seen since the late 1990s. In March, the employment rate for people in their prime working years reached 80.7%, the highest it's been since 2001. Overall, the labor market continues to demonstrate strength and resilience, despite the persistent calls for an impending recession. Now let's take a look at consumer debt. The economy continues to exceed expectations, but some concerns like consumer debt have emerged. Recently, there has been growing concern about a surge in credit card debt. However, after taking a closer look, the situation is more nuanced. In the first quarter, card balances remain stable and disposable income growth has been strong. As you can see in the chart, debt service cost as a percentage of disposable income is actually relatively low at 9.7%. That's lower than what it was pre-pandemic and well below the historic average, indicating that debt repayment has so far been manageable. Contrary to some of the headlines, the data on consumer finances does not indicate significant reasons for concern. That said, consumers remain anxious with consumer sentiment coming in well below the 20-year average. Now let's go through our markets at a glance. For U.S. equities, the S&P 500, representing large cap stocks, posted an 8.7% return for the quarter and a 19.6% return for the year. Growth outperformed value for the quarter, but underperformed for the trailing 12-month period. 8 of the 11 S&P 500 sectors saw gains this quarter, with technology performing the best at an increase of a stunning 15.4%, and utilities performing the worst, down 2.5%. Small caps returned 3.4% for the quarter and 9.8% for the year. For international equities, the Developed International Equities Index returned 3.0% this quarter and 18.8% over the last 12 months. Meanwhile, emerging markets gained 0.9% and 1.8% for the trailing 12 months. Emerging markets struggled due to U.S.-China tensions and concern about the Chinese economic recovery, which appears to be stalling. For bonds and fixed income, the Bloomberg U.S. Aggregate Bond Index had a negative return of 0.8% in the second quarter and just under a 1% loss over the past 12 months. The yield on the 10-year Treasury bond rose to 3.81% at quarter end, up from 3.48% in the previous quarter and significantly higher than the 3% level a year ago. Meanwhile, high yield returned 1.6% in the last quarter and 8.9% over the past year. Before we conclude, let's take a closer look at the inflation numbers. As we can see in the graph, headline CPI has continued to decelerate over the past 7 months. Year over year, headline CPI inflation declined from a peak of 8.9% in June of 2022 to 3% in June of 2023. Core CPI, excluding food and energy, also decreased from 5.9% in June of 2022, but remains above the 2% target. The June CPI report was a positive surprise. The good news is that inflation is falling and expected to continue on that trajectory, and so far is doing so without a rise in unemployment or an economic slowdown. So how does this factor into growth? The U.S. economy kept up its positive momentum in the first quarter of 2023 with a solid annual GDP growth rate of 2%. This follows the growth rate of 2.6% and 3.2% in the previous 2 quarters. After bouncing back in 2021, the economy went through a period of slower growth and even some rough patches in 2022. However, the first half of 2023 has shown the economy's resilience, with data pointing towards continued improvement. So let's review what we've covered. The Fed paused rate hikes in June, but resumed in July. Mixed signals from the Fed and projections from officials suggest potential future increases, leaving uncertainty about the path of rates. Inflation, a crucial factor for the Fed's decision-making, has shown positive signs of deceleration and is expected to decrease in the second half of 2023. Last year, there were concerns that we'd need a recession to bring down inflation. But now inflation is decelerating and expected to slow even further, all without a rise in unemployment and an economic slowdown. As a result, the fear of a recession has diminished, at least for now. The U.S. job market is going strong, with notable job growth in the first half of the year and historically low levels in unemployment. And despite headlines regarding increasing credit card debt and concerning consumer sentiment numbers, a closer look at the data on consumer finances is not showing much of a concern, at least at the moment. Looking forward, the headwinds from last year are fading, and the big picture is that the economy is normalizing. Consumer activity has been a crucial driver for the economy and remains robust. The main risk of a recession last year was the aggressive rate hiking by the Fed, which negatively impacted housing, financial markets, and business activity. However, there is positive news as these sectors are now showing signs of improvement and market conditions are gradually improving as the Fed approaches the end of the rate hike cycle. All in all, we believe there's much to be optimistic about as we move into the second half of 2023. That concludes our market summary for the second quarter of 2023. I'm Brent Petty. Thanks for watching.